So Florian gave a really concise overview of the spectrum, and we at Tilia Impact Ventures, we position ourselves right in the middle. So we're an investor for impact, and we do both social investment and impact investing. And clearly, there are no boundaries set in stone that make a clear distinction, and we ourselves consider ourselves as a pilot here in the Czech Republic. Tilia is among the first impact investment funds in the CEE region. So we raised quite a small fund to basically give it a try, run this pilot, and provide a proof of concept that impact investing, deep impact investing, is a viable concept for the Czech Republic. I think this slide is really a great summary of the whole spectrum. I can personally relate to this because I also sit on the board of the largest Czech foundation. We focus on the systems change in education, and we're much further to the left at the foundation, and we, I believe, are doing engaged grant making. And it's quite a different story as compared to traditional grant making. But perhaps we can come back to this later on. Florian, can we move over to the next slide? Tilia, in brief, we're a closed-end 9-year fund. We raised 2.3 million euros for this fund, basically through family and friends. We have around 20 investors. 2 of them are institutional. All of them are based in the Czech Republic. We didn't want to raise a larger fund, and clearly, financially, such a fund doesn't make sense economically, right? It's too small to provide a reasonable scale for, upholding reasonable operations. Nevertheless, we're 6 people altogether. It's 2.6 FTEs because we wanted to run this fund as professionally as possible to make sure that we provide a very professional and mindful demonstration of the proof of concept I was talking about. When it comes to fund structure, we're technically an endowment fund. So technically it's an NGO, but when we raised the second fund and we're currently thinking about it, strategizing for Tilia 2, it would have to be a standard SPV falling within the regulation of institutional investing. So that would be a different ball game then. When it comes to investment focus, as I said, we're investor for impact, not with impact. So we call it an impact first approach. So basically, even if it did find the next Apple or Facebook, we wouldn't be able to invest in it, even though it would make total sense financially and from risk perspective. The only impact first ventures qualify for the screening, but I will come back to this later. We're sector agnostic, so we felt Czech Republic having 10.5 million people is quite a small market, so we didn't feel we could afford to be sector specific. But of course, going forward, this is the way to go, to invest in what we understand and have industry focus and build deep knowledge and deeper networks within that particular sector. Investment phase, a rather early stage fund, seeds to startup. Location, it's clear, Czech Republic. Our investment period is 5 years. So it's 5 + 4 years altogether, hence the 9-year closed-end fund structure. When it comes to investment structures, facilities, and I think this is going to be the focus of our of our conversation today. We're really open to basically anything, but mostly in the 4 deals we've made today and the deals that are in the pipeline, it's convertible loans or tailored mezzanine loans. We're also open to equity or revenue shares or blended finance, guarantees. I mean, we really want to tailor the investment structure to the needs and the context of the organization. When it comes to themes, we are aligned obviously with the SDGs. However, the 4 themes that we have the most focused on is social inclusion and civic empowerment, quality education, environment and sustainability, and health and well-being. And yes, it sounds pretty straightforward, but even we're 2.5 years down the line since the inception of the fund, we still have quite heated debates about what is in scope and out of scope of our of the fund, because health and well-being, for instance, is very specific, a very specific theme. We've made 4 investments today, and today I'm going to talk briefly about 2 of them. Florian, thank you. So as Florian really beautifully set out at the earlier part of the presentation, there are 3 steps that we take. The first step 1 is assessing the preconditions for us. We have Magdalena, who is an impact manager working full-time for us, and her one of her key tasks is to safeguard our impact first principle. And you know, that can get super complicated, and we talk about our additionality and drop off and dead weight and all the other concepts that at the end of the day may need to be assessed to make a mindful decision whether this is an impact first deal or whether the impact is kind of a byproduct or it's not intentional, etc. So our first step is really screen the potential venture. We of course take a look at the SDG alignment, but we have our proprietary scoring table. We took the best from the TONIC deal screening, Bridges Ventures radar, and the impact management project, the IMP. And we take a look at impact, financial and operational aspects. If that goes through, we do the due diligence, the standard DD, and deal preparation. We deep dive into the theory of change, look at their impact strategy. Typically, they don't have the impact strategy as complete as we would like to, so we typically are very involved in revisiting that strategy, and then we collaborate on defining the right KPIs and impact goals. And of course, after the investment and technical assistance, we take a look at reporting, managing the impact. We provide extensive non-financial support. Personally, this is the part I get most carried away with, because I really like being engaged with the investees hands-on, and we also need to report to our investors on the portfolio level and of course on the company level. So that was really real quick. I hope we will we'll get back to this. Florian, next please. We put the screenshot of our scoring template. As you can see, we have 5 dimensions. We take a look at the current scoring and the risk exposure, right? And I mean, this can get pretty technical. So I will come back to this only if you're interested and have a question about it. And on the right side, you see the IMP dimensions: what, who, how much, contribution, and risk. So we also try to assess where we stand and what we want to see. Florian, thank you. The first case is Datlab. It's a Czech IT company. It's basically a bunch of IT geeks who have probably the best data in the world about public procurement. If I take the Czech example, and I'm positive that they have by far the best data, much better than data about public procurement than the government itself. Half of our taxes is spent on through public procurement tenders. And the level of transparency was really low. Obviously, there is corruption, but of course, also the culture within the sector is not data-driven, evidence-based, and overall the quality of public tenders is at best mediocre. So Datlab is taking data and evidence-based approach to build transparency around public procurement, and they've built a number of products based on the data, and they've gathered not only for the Czech Republic but for dozens of countries around the world. So basically, the business model is on analyzing the data, gathering the data, analyzing the data, and building products above that for the buyers and suppliers likewise. So that's the situation. It's our first investment. They have a massive potential, but of course it's B2G, business to government, and that makes the whole story even more complex. Florian, next please. Thank you. So how did we go about the needs, right? First of all, this particular company could even get a bank loan because they already had revenues. They had like over 200,000 euros in revenues back then, and they were able to get a reasonable loan from the bank. But after some conversations with them, they understood that if they want to grow, it's really not a good idea to take a loan because they need growth money, that it's not repaid for at least some time. So we had multiple conversations with them. They didn't want to do an equity deal. So right now, or back then, we agreed on doing a convertible loan with 2 tranches. This deal was smaller. Our maximum at Telia is 200,000 euros that we can do ourselves, and we typically co-invest with others. But this deal, we did alone. We did this deal alone. There are 2 tranches, and it has 5-year maturity, 2-year grace period, after which not only the interests but also the loan itself is being repaid. I think the interesting part here is that we really had conversations about how much we are aligned as an investor, an impact investor, and them as being social enterprise. And they have a complex structure. They have an NGO and a for-profit social enterprise. So obviously you cannot convert into an NGO. So the investment is made towards the social purpose organization, a limited liability company. And we agreed on bullet repayment structure. And if they achieve their impact KPIs, the payment is 33%. If not, it's 40%. So there is also a monetary or financial, if you will, motivation for them to stick to their social mission, because we identified at the early stage the risk of mission drift. They have really great data, and they can sell the data also to real estate companies or like big four companies for business purposes. And we felt that the co-founders, their impact first, but being a responsible investor, we wanted to also have a binding agreements within the contract. So that's why we proposed this, and Datlab agreed on that. Florian was talking about extensive non-financial support. And I think we must have spent hundreds of hours working with Datlab on building their strategy. We even invite our friends at the BCG Consulting to provide a full strategy project pro bono with them. So the managing partner and his team spent 6 weeks working with Datlab to help them build a go-to-market strategy and an expansion strategy from the Czech Republic to other countries. So that was a fantastic experience. We also helped them a lot with governance and building the team, and also building their particular products. Well, I tend to go into a lot of details because I don't have a visual contact with you, and I find everything so interesting. But I will probably pause here with Datlab and move on so that we can open the floor ASAP. The second case study, I'll try to take this one quicker. It's DotGlasses. I have to admit, even though I spent some time being a volunteer in Africa in a slum, I didn't know that vision and lack of diagnosis and lack of access to glasses is a massive issue. And there are billions of people who lack the diagnosis and lack the glasses, and therefore kids cannot really participate at school, even if they go to school, and their grandmas or relatives cannot help them in educating them at home or being engaged in the community and having a proper work. So I was really blown away when I saw studies, evidence-based studies, that if you invest $1 in vision, that's diagnosis and provision of glasses, the economic impact is 25x. So it generates $25 for each dollar. And there are a number of NGOs engaged in this problem, but it's really big. And the founders of DotGlasses saw that the glasses currently being provided to the bottom of the pyramid, they don't look nice, they don't last because they're of poor quality, they break really fast, and they're quite expensive still. So they came with a product that they recently won a Red Dot Award. The glasses look fantastic. I should have brought them with me, so apologies, but they look really nice. And I mean, the sweet part is that you don't need a optician to diagnose. People can be diagnosed by distributors who take a 30-minute training and can diagnose you with your eyesight defect and provide you with the glasses at the spot. So it's really a revolutionary product. They have over 1,000 of negotiations right now in many countries around the world. And this is potentially a game changer, not only for the local governments, but also for the micro entrepreneurs and NGOs working in the poorest countries around the world. When it comes to a financial instrument, That was pretty clear. This is a high growth, high potential company. So we talked about convertible loan from day one. We contributed 200,000 euros, and we led the whole round of 1 million US dollars. So there was 2 more institutional investors and a number of business angels taking part in this seed round. We also identified the risk of emission drift clause, so we can ask for repayment of the loan if less than 50% of the revenue is generated in alignment with the impact strategy and the mission. Florian, next slide, please. This is a little note about our funnel, because I get a lot of questions, like all the VCs complain about their deal flow, and if you take their deal flow and divide it by 100, this is our deal flow, right? Because we look for financially viable social purpose organizations. And clearly in the Czech Republic, 30 years ago, it was illegal to be an entrepreneur, let alone being in an ex-communist country, and you guys know what I'm talking about. So let alone social entrepreneur. So we don't have the tradition, and traditionally we have a lot of NGOs. And if they do entrepreneurship, it's social business in terms of creating employment opportunities for marginalized groups of people. And that typically doesn't entail a sustainable business model, even though we spend a lot of time looking at this and we have some potential ventures in the pipeline. But overall, we did the screening of over 400 ventures. We presented a little over 3% to the investment committee, and we invested 4, and the 5th is in the making. It should be announced hopefully next month. So the pipeline is pretty steep, and I think there are a lot of learnings. It's much more labor intensive to get great deals. And I can then talk about how we get the deal sources, because it's also important for structuring well our investments. Perhaps one little note to illustrate: we like to collaborate with other VCs, right? But they need to understand their impact first. So a lot of them are really nice people, but they basically take the approach, at best, investing with impact. So they kind of say, well, you will see when you will know when you see it, right? The impact. So I mean, if it deals with particular topic, they feel that the impact is inherently there, but it's not. And typically, it's more complicated than that. So we can be a real troublemaker for other VCs when it comes to impact, and we slow down the process, and we have many questions, and we don't take yes for an answer. We want to see the evidence. So we really take the evidence-based approach, and that's for some it's a delay and a distraction. So the lesson learned is that the cap table of the investors need to be aligned, right? Because then we have different time horizons, priorities, etc. Well, I think I'll pause here.
Yes, thank you very much, Peter. This was very interesting and very clear. I think it's time now for the audience to plug in questions into the Q&A box. I will start by asking some questions myself, waiting for the audience to actually also tell us what is the most interesting aspects from their point of view, because you have touched so many points and we could spend hours into discussing each of them. So maybe I'll try to ask a question a little bit on each relevant item, but then I'm really waiting also for the audience to tell us what's most interesting for them. So I would go first of all with a question on financial instruments, because we have an audience that I think it's a very diverse one, and many of them them are not confident with financial instruments. So maybe if very shortly and not in a technical way, but you can tell us what is the main difference, and also somehow relevant characteristics when you discussed about convertible loan, mezzanine loan, equity. Just maybe give some main points of the difference between an equity investment and a loan, and also what it is a convertible loan, why it has an impact dimension that is very relevant.
Yes, Sarah, thank you for this question. It's a simple question, but difficult at the same time, right? I'll try to take it really from the basic point of view, and sorry if I insult the ones who are very familiar with this, but when you talk to traditional people from the social sector, they consider loan, right? Because they think this is the way to go, and they kind of expect, because we have to deal with impact, that the loan will be at 0% or perhaps low interest loan. And it takes, for me, surprisingly long time to explain that loan can be a really bad idea for them, right? Especially if they're high growth potential. So we try to we need to put it bluntly, educate the market a lot that equity is not a bad thing. Equity is a good thing if they are high growth and they won't have the capacity to repay anything in the next 5 years, because they need to reinvest everything into growth, or they might not even have the ability to repay anything because they might be burning cash for 2 or 3 years. So them being quite risk averse, our target group typically is inclined towards loans, and we can have a good conversation with them when we see their business plan. If they're high growth potential, then it doesn't make sense for them to create a loan structure. Equity makes sense for high growth, and if, of course, their structure enables an equity deal, so they need to have a public company or a limited liability company that enables for stakes to be taken.
So what you're saying is also there needs to be a buy-in at the cultural level for the organization to share with you the same vision in terms of growth and impact growth, and this is the relevant point as well.
Exactly, Sarah. Thanks for stepping in. And I'm really surprised, how basic the conversation starts, right? Because typically these people go to the impact sector because they want to make a difference, right? And they typically is their first investments to be considered, or if they've seen a financial instrument, it was a loan at a different organization. So that's one thing. Another thing is they're really scared of us being an intrusive investor, right? If typically they want to keep everything to themselves because they're scared we will take it away, or if it becomes successful, we won't want to rip them off. So it takes some time to build a trust that we want to contribute to making them successful, and perhaps if they say equity or equity-like structure, we are a little bit we take part in a little bit in their success, doing a decent exit. So then typically they start to understand, if we explain how convertible loan works, then they understand, okay, so if we're successful, take 20% discount at the next valuation, and basically our success is your success, and not vice versa. And if they're not successful, it's our problem, right? From the financial point of view. So it takes a long time, and the more the people are detached from the business sector, the longer it takes to build a cultural alignment. Second, they don't understand the difference between financial investor, impact investor, and a strategic investor. So I think it might be interesting to explain this a little bit. So obviously, impact investor is us, right? We invest for impact. Impact is at the core, while a financial investor has different objectives. And I'm not blaming anyone. It's just an alternative, totally relevant route is to maximize financial return, right? And they're obliged to their investors to push for maximum return at the lowest risk. So it takes a lot of time to explain that, at the important business decisions where we as investors or members of the board are consulted, we will take the impact perspective, probably long-term, and maximizing the long-term impact, of course, through securing financial viability. So many times there is a trade-off between finance and impact, and balancing the two is also the responsibility for a responsible investor. While a short-term financial investor wants to maximize his or her exit, and that's about it. And clearly, strategic investor, we invested into a circular economy startup that won global prize in reuse, and we did a convertible loan agreement. Later on, they found a strategic investor, and we converted and currently hold 3.57%. And we had a disagreement with that company because we felt like it's too early for the strategic investor because they're still in growth phase. Of course, strategic investor has totally different expectations from the investor. They are not looking for exit, but perhaps control or R&D potential, etc. So really, alignment of goals. Again, it's much more difficult and complicated than I thought before. And that alignment of goals and interests is a prerequisite of finding the right structure. Long-term, short-term, loan, equity, revenue share. So for me, with every deal is different. We have a different structure, and it's a great learning opportunity.
This is a very, very relevant comment, because this workshop is called tailored financing. This is why it takes so much time and resources, and it's really based on the needs of the social enterprises. And we at EVPA, we think you do a great work at Tilia Impact Ventures, and we are so happy to showcase this example today.
Even though I have a financial background, I wouldn't be able to do this by myself. My partner, Silke, she has expertise, and we have an amazing investment committee. And those are people who have been doing investments for decades, and we borrow from their depth and breadth of knowledge, and they advise fantastically what is the right instrument, because a lot of technical knowledge needs to be obtained, and I myself confess that I don't have it, and sometimes I'm at a loss what is really the best approach to take, and we consult a lot our investment committee to structure it the best way, in the most tailored way to the needs of the SPO, but also for us, because we also need an exit story. We also need...
Exactly, yes, this was another question. You mentioned this before. The exit is always a challenge. So when you say you are very attentive to mission drift, so you plan your exit from the beginning of the investment. So now you have 4 deals. You already have an idea of what is the exit phase, or not really?
I would love to say yes, we have a total control of how it's going to unfold, but clearly not, right? A year and a half ago, the COVID came, and really no one really knew what it would mean, this black swan. So 2 out of the 4 investments have been impacted heavily, by COVID, so that postponed or even derailed some of the developments. So we need to re-strategize, and honestly, for 2 of the deals, I think we have pretty reasonable exit pathway, because they grow, they have market traction, they have impact. So I think they'll be able to do next rounds, and probably not the next round, but the following round would be an opportunity for us to exit. And for the other 2, one of them is a loan, so I think they'll be able to refinance. They won't be able to repay the loan in full, but I think they will be able to refinance as at the minimum. Perhaps they will take off, but this is the fallback scenario. And for the 4th one, I mean, it's a question mark. And if it goes badly, we might have to write it off. And if it doesn't, perhaps they'll be able to refinance. And exit at a multiple is currently unlikely, but as you say, you never know.
Thank you. This is nice insights. I have a question for you, which I think can be interesting for all those that are online, on setting up your fund. So we would like to know more on how difficult it was and what is your experience and some advices for those who would like to set up their first fund. So no track records and no endowment. How do you do that? What is your advice? Where did you start it?
Well, I wouldn't dare to give you any advice, because this is, super context relevant. I come from the Impact Hub network, and we always say we're globally connected but locally rooted. See, it's great to be part of the EVPA, to learn from the best, to learn from their mistakes and their successes. Yet we had to make a decision, and our decision was to start small, because I personally like to underpromise and overdeliver, and I didn't want to raise a big fund and then end up with low deal flow and inability to make great investments. So I kind of felt respect for the size of our market, and our market is small, and CE is quite fragmented market. We all speak different languages. We all think we're super special and don't talk to each other enough. The deal flow from the Czech Republic is by definition small, given the size of the market and the maturity of the market. And we don't get much, deal flow interest from outside, because no one really wants to scale to the Czech Republic, right? There is no reason for that.
Maybe they just don't know you.
Oh yeah. So it's also a question of our additionality, right? What is the additionality of us as a fund? Of course, we can provide a little bit of money, but as an investor, how do we add value? Various consultants, Impact Hub network, incubation, acceleration, strategic consulting is also something that helps a great deal. It's really, everything is connected to everything, right? So our approach was to start small, to do an endowment fund, an NGO, but as a kind of short-term vehicle to test.
Yes,
and that proved as a success. We of course had to deal with the regulator. So we talked to the Czech National Bank, that's legally responsible for market regulation, and we consulted with them, and they confirmed that it's okay for us to do this structure. We hired reputable lawyers to help us with drafting the structure. However, the condition for that is that, you know, the regulator saw that there is a trade-off between impact and return. So basically, the expectation is that we're going to be making below market returns because we don't compete with standard VCs and we look for impact. So that was the investment narrative. And
yeah, thank you. I think that's very interesting. Many of our members that are part of the Impact Funds initiative has started like this, so with a small fund to prove the concept and then have scaled up, either by matching with European Investment Fund money or by simply looking for other investors to raise other funds. I'm just adding in the chat now a link to, there is a new podcast series that we are launching. So these are really how to raise first social impact funds. So it can be interesting to have a look. And then there is a question now, just maybe one question because we need to close. What kind of organization you would wish to fund next to have a new member in your SPO portfolio? So what is your investment dream, I would say?
Well, being a board member of the foundation focused on education and being father of 4 kids, I would love to invest into an education SPO. This is where I have a lot of passion for, and clearly it's also a challenging sector to strike a viable business model. So yeah, education is something that we would all love to do.
And you also invest in companies that are not based in Czech Republic, as we saw for Dot Glasses, or this was most of an exception?
Well, Dot Glasses is based in the Czech Republic, but they operate.
But they operate in development countries, okay.
However, yes, we are open because we like to experiment to do also something that's totally unrelated to the Czech Republic. But clearly we want to have our added value, right? We just don't want to provide the money and then, you know.
So this is an invite to send applications if you have an education-based SPO that is looking for social investment.
Check out our website, and if you have an SPO, we would love to take a look at it. And we're ready to do 1 or 2 deals that's outside of Czech Republic, and
why not?
Just to experiment and prototype.
Thank you. Thank you very much, Peter, for being online. It was very nice to have you and to have Tilia Impact Ventures showcase during this brief session. We would love to spend more time into asking questions, but unfortunately our time is coming to an end. I remember all of you that this session is recorded and the slides also will come to you, I think, through the website. And I'll leave the floor to Florian now for a final recap of the session. Thank you again, Peter. It was really interesting.
Thanks for having me. Have a great one, everyone.
Thank you.
Thank you very much also from my side. It's always great, as you said, it's good to be part of a community where you can share your successes, but also your failures, because you learn from from the failures, obviously. So it's great to have really also open members together with us in EVPA as a community, to really be a learning community where we can learn from each other and do better. And so thanks again for this insight to add the practical view on our theoretical framework.